A study of thousands of the average households found that people who follow a simple written budget save 43% more every month than those who do not. Not 5% more. 43% more. Same income, same city, same expenses, completely different outcomes. I am going to give you that system right now. Here is a number that should make every single person watching this video uncomfortable. Research consistently shows that the majority of the average households spending above average incomes report that they feel like they do not have enough money. Meanwhile, studies of genuinely wealthy individuals show that the majority achieved wealth on moderate incomes by being exceptional at managing cash flow, not by earning unusually high salaries. The gap between these two groups is not income. It is systems. Specifically, it is whether a person has a conscious, consistent, and effective system for managing their money. In other words, it is building a one-year financial plan. Today on Daksha Luma, I am going to give you the complete framework for building a one-year financial plan designed specifically for your salaries, expenses, and your financial products. We are going to cover 3 different budgeting frameworks so you can choose the one that fits your personality and life stage. I am going to walk you through a real example of how a major city professional completely transformed her financial situation in 12 months using nothing but building a one-year financial plan and the same salary she had before. And I will give you a specific 7-day implementation plan so that by this time next week, you have a functioning system. Let us get into it right now. Let me describe in very specific detail why most people struggle to build savings even when they earn a decent income. The problem is not that they are careless or irresponsible. The problem is that they are trying to manage money manually in an environment that is specifically engineered to make you spend as much as possible, as conveniently as possible. Every UPI transaction is frictionless. Every app has a one-tap purchase. Every food delivery platform sends you a notification when you are likely to be hungry. Every e-commerce site knows your purchasing history and serves you targeted deals. Every EMI is designed to make large purchases feel small by spreading them over months. This is not a conspiracy. It is just the natural result of companies competing for your spending. And without an equally deliberate system on your side, the default outcome is that spending fills available income, savings never materialize, and wealth never builds. The specific pattern looks like this. Salary arrives. Essential bills are paid. Spending on lifestyle follows naturally because the money is there. By month end, some unexpected expense always seems to appear. The savings plan gets pushed to next month. Next month, the same thing happens. This is not a character flaw. It is a system design flaw. And building a one-year financial plan fixes the design. The beautiful thing is that once you have the right system in place, good financial outcomes become almost automatic. And you know what genuinely made me laugh the first time I understood this properly? The solution is not complicated. It is actually really simple. So simple that once you see it, you will wonder why nobody explained it to you years ago. But here is where I have to pause for a second. Because this is also the part that honestly made me sad. Genuinely sad. Because millions of people are missing this every single day. Not because they are not smart. Not because they do not care about their money. Simply because nobody ever sat down and explained it to them clearly. Well, that changes right now. Let me walk you through it step by step. Let us go deep on building a one-year financial plan with 3 complete frameworks you can implement today. Framework 1, the 50-30-20 rule. This is the simplest entry point into building a one-year financial plan. Every rupee of take-home income is allocated to one of 3 buckets. The needs bucket receives 50%. This includes everything that is a non-negotiable essential: rent or home loan EMI, electricity, gas, water, groceries, internet and phone plan, health insurance premium, and transport to work. The critical test for whether something belongs in needs is, would your basic life become significantly harder without it? The wants bucket receives 30%. This covers lifestyle spending that you choose but could live without: dining at restaurants, streaming services, gym memberships, clothing beyond basics, hobbies, entertainment, travel, and social spending. The future bucket receives 20%. This is your most important allocation. It covers emergency fund contributions, SIP investments, additional loan repayments above the minimum, and long-term savings goals. The power of the 50-30-20 rule for building a one-year financial plan is its simplicity. You do not need to track every individual rupee. You just need to monitor which bucket each major expenditure falls into and ensure you never consistently overspend a bucket. If your needs regularly exceed 50%, you have a structural problem. Either your income is not enough for your cost of living, or your fixed commitments are too high relative to your income. This is the most important signal the 50-30-20 rule gives you. Framework 2, Zero-based budgeting. This is a more rigorous approach to building a one-year financial plan. At the start of every month, you assign every single rupee of expected income to a specific purpose. Example: income, $70,000. Rent, $18,000. Groceries, $8,000. Utilities, $3,000. Insurance, $2,000. Transport, $4,000. Dining out, $4,000. Shopping, $5,000. Entertainment, $2,000. Subscriptions, $1,500. SIP investment, $12,000. Emergency fund, $3,000. Loan overpayment, $2,500. Buffer for miscellaneous, $5,000. Total assigned, $70,000. Balance, 0. Zero-based budgeting means zero unaccounted dollars, not zero savings. Every rupee has a job. This approach is significantly more effective than trying to save what is left over. The monthly process. On the first of the month, open your budgeting tool and create the plan. Automate your investments and savings transfers on salary day. Track actual spending against the plan weekly. On the last day of the month, review. Framework 3. Pay yourself first. This is the simplest and most powerful concept in all of building a one-year financial plan. The principle is that you save and invest before you do anything else. The moment your salary arrives, an automatic transfer moves your predetermined savings amount to a separate account or investment. You then live on what remains. The crucial mechanics: your SIP should deduct on salary day or one day after. Your emergency fund contribution should deduct the same day. You should never have to consciously think about or decide whether to save. The automation does it for you before the money is available for spending. Most people save what is left over. Wealthy people spend what is left after saving. This one inversion, combined with automation, is responsible for more your wealth creation than any specific investment choice. Tools for implementing building a one-year financial plan globally. The Walnut app reads your bank SMS messages and automatically categorizes your spending. Money Manager is an excellent manual tracking app with clean visualizations. Google Sheets with a simple custom template is free and infinitely customizable. Your bank's own UPI app analytics in PhonePe, Google Pay, and BHAM gives category breakdowns of your spending automatically from transaction data. Let me show you building a one-year financial plan in action through a real 12-month transformation example. Neha is a 29-year-old HR professional in Delhi earning a take-home salary of $65,000 per month. She never tracked expenses deliberately and consistently ran out of money by the 25th of each month. Here is what her spending actually looked like before applying building a one-year financial plan. Housing rent, $18,000. Groceries and household, $7,500. Food delivery apps, $8,200. Shopping, clothing and Amazon, $9,500. Active subscriptions, $3,100, of which she was not actually using $1,400 worth. Petrol plus Ola Uber, $5,500. Personal loan EMI, $6,000. Outstanding balance, $78,000 at 18% interest. Miscellaneous including unknown impulse spending, $7,200. Total spending, $65,000. Net savings, 0. Neha applies building a one-year financial plan using the zero-based budgeting framework. Month 1 and 2, emergency debt elimination mode. She cancels $1,400 of unused subscriptions immediately. She reduces food delivery to $3,500 by cooking more at home. She reduces shopping to $3,000. She directs $18,700 per month toward loan overpayment. Loan cleared in less than 5 months instead of 13 months remaining on the original schedule. Interest saved, approximately $8,400. Month 3 to 7, emergency fund building. Loan is cleared by month 5. The 6,000 rupee EMI slot is now free. Plus the 12,700 she was overpaying. Total freed up, $18,700 per month. She directs this entirely to a liquid fund emergency fund. By month 7, emergency fund reaches $1,200,000. Month 8 onward, wealth building. Neha now has zero consumer debt and a growing emergency fund. She applies the 50-30-20 rule on a stabilized budget. Needs, $32,500. Wants, $13,000. Future, $19,500. Future allocation, SIP in S&P 500 Index Fund 10,000, Tax Saving Fund 5,000, Emergency Fund Top-Up 4,500. At the end of 12 months. Personal loan, cleared. Emergency Fund, $1,500,000 in liquid fund. SIP portfolio started, $50,000 invested. Monthly savings rate, 30% of income. Projected portfolio at 35 on current trajectory, approximately $400,000. Same salary. Completely different financial trajectory. The only variable was building a 1-year financial plan. Here is your specific 7-day challenge to implement building a 1-year financial plan starting today. Day 1. Download a budgeting app or open a Google Sheet. Choose one and set it up. The specific tool does not matter nearly as much as starting. Spend 20 minutes today. Day 2. Pull up your last 3 months of bank statements or UPI transaction history. Write down your top 10 spending categories and the average monthly amount for each. Be honest. No category should be labeled miscellaneous. Name every rupee. Day 3. Categorize every expense into needs, wants, or future savings. Calculate what percentage of your income went to each. See where you stand relative to 50-30-20. Day 4. Identify your top 3 spending leaks. These are categories where the number surprised you or where you spent money without much conscious decision. Write them down. Day 5. Set up your automated transfers. SIP deduct on salary day. Emergency fund contribution deduct on salary day. These should require zero willpower to execute. Day 6. Cancel every subscription you have not actively used in the past 30 days. Check your email for subscription receipts if you are unsure what you are paying for. Day 7. Write down your 6-month financial goals with specific numbers. How much do you want in your emergency fund in 6 months? What do you want your monthly investment amount to be in 6 months? Specific numbers make goals real. Building a 1-year financial plan is the foundation of every other good financial decision. You cannot invest effectively without it. You cannot eliminate debt without it. You cannot build wealth without it. But once you have it, everything else becomes dramatically easier. Please share this video with someone in your life who has been meaning to get their finances in order. That could be the most valuable thing you do for them today. Subscribe to Daksha Luma for a new finance video every single day. See you tomorrow. Stay financially disciplined. Before you go, I have one small request. If this video gave you even a single insight that you can apply to improve your finances, please hit that subscribe button right now and tap the bell icon. That is the only way YouTube will notify you when our next video goes live. And honestly, every single day we publish a brand new finance education video right here on Daksha Luma. Completely free. No paywalls, no courses to buy. Topics like investing, mutual funds, tax saving, budgeting, and everything in between, all explained simply and practically for you like you and me. If you have questions, drop them in the comments below. I read every single one and reply to as many as I can. Your financial future is absolutely worth investing this time in. Thank you so much for watching. I will see you tomorrow, right here on Daksha Luma. Take care of your money.